Welcome back to the Deep Dive. This is Talk Tickers, and today we're digging into Ferguson, ticker FRRG. They dropped their final fiscal quarter and full-year results pre-market September 16th.
And the market reaction was pretty immediate and strong. These weren't just good numbers. They really seemed to affirm the strategy.
Yeah, constructive tone, definitely. The stock jumped almost 8% right after.
And it held those gains. That tells you something. It signals real confidence that Ferguson's executing well, even with, pretty mixed economic picture out there.
Right. So that market reaction points to a high-quality beat. Let's lay out the core numbers that caused that stir.
Okay, focusing on the adjusted figures, which investors really watch. Adjusted EPS came in at $3.48.
Which was well ahead of expectations.
Yeah, beat by about 47 cents. That's nearly 17% growth year over year. 16.8% to be precise.
And that growth wasn't just from cutting costs, right? Revenue looks solid, too.
It did. $8.50 billion, up 6.9% year over year. But I think the real story, the thing that grabbed attention and pushed the stock, was the profitability.
The margins.
Exactly. Margin expansion was, the headline. Adjusted operating margin up 60 basis points. Landed at 11.4%.
Okay.
And that leverage pushed adjusted EBITDA up, too. Over $1 billion, $1.03 billion, up 13.6% year on year. I mean, a beat like that suggests they're managing costs and shifting to higher value business.
And while they're generating all that cash, they kept the shareholder returns flowing.
Yep. Continued the buybacks, $189 million worth in Q4 alone.
And for the full year, that took about 5 million shares off the table.
Right. And they also sweetened the pot with the dividend, declared 83 cents per share quarterly. That's up 5% from last year.
Dynamic capital allocation, it seems.
It is. Strong operations funding growth, M&A, and returns.
Yeah.
It's, a powerful combination for investors.
Okay, let's unpack this a bit more, because this is the key question, right? The U.S. housing market's been kind of lukewarm. Construction starts soft. How did FRG pull off almost 17% ETLS growth? Where did that volume actually come from?
It really comes down to their market mix. You saw a pretty stark divergence in their U.S. segments. The heavy lifting came from non-residential. Revenue there actually accelerated, grew about 15% year over year. That's their structural advantage playing out.
15% is, huge for a company of their size. What specific areas drove that?
Two main ones really stood out. Commercial mechanical, that was up 21%.
Wow.
And waterworks, up 15%. And this isn't small stuff. It's driven by these massive, long cycle projects. Think huge data centers, large life science facilities, big government water treatment plants.
Complex projects?
Exactly. Projects that demand the kind of multi-customer group solutions that, frankly, RG is uniquely set up to provide.
So conversely, the residential side, still about half their U.S. revenue. That must have felt some pressure.
It did. Residential was essentially flat year over year, still facing those headwinds, higher interest rates hitting new construction and softer demand in RMI repair, maintenance, and improvement.
So the non-res strength wasn't just offsetting the residential weakness, it was actively pulling the whole company forward.
Precisely. It provided more than enough lift for really impressive overall growth.
Let's swing back to margins then. Gross margin hit 31.7%. That's a big number. Analysts were definitely watching that. How did they get that 70 basis point expansion? Was it just cost cuts?
It was two main things, really. First, those streamlining actions they took earlier, they're kicking in. Expected to yield about $100 million in annualized savings now.
Okay.
Second, they actually saw pricing power improve in Q4. Pricing contributed about 2% to revenue growth.
So pricing power returned even with deflation in some areas.
It did, but you got to put a little asterisk there. Management was clear that while net pricing was positive, it was dampened a bit by low single-digit deflation in some commodities, PVC pipe specifically. Still volatile.
Okay, and here's where it gets maybe a little nuanced for investors. Management said that 31.7% gross margin, it's not sustainable right away. Why? Are they just being cautious, sandbagging?
No, I think it's genuinely about timing, and it's actually critical information. They explained that Q4's gross margin had some temporary timing benefits baked in, meaning there were quick passing supplier price hikes to customers, but they were still selling inventory bought at the old lower cost. That creates a temporary boost.
Okay.
So they expect that gross margin to settle back into like the 30% to 31% range longer term once that timing effect washes out.
Got it. And that context helps explain the forward guidance then. Let's look ahead. What did they signal for the calendar year?
Right. They gave a full outlook for calendar year 2025. They're expecting mid-single-digit revenue growth.
Okay.
And the key margin target. Adjusted operating margin guidance is 9.2% to 9.6%. Now, that's important because it's still a 10 to 50 basis point improvement over the prior calendar year. Shows confidence in leverage, even with gross margins normalizing.
And they're planning to invest behind that growth, CapEx.
Yep, signal $300 million to $350 million in CapEx.
Now, what about this strategic sort of housekeeping move, changing the fiscal year end? Sounds technical, but seems like there's a real operational reason.
Oh, it's much more than just housekeeping. Shifting the year end from July 31st to December 31st. It does two things. For investors, yeah, cleaner comparisons, calendar year to calendar year.
Right.
But maybe more importantly, operationally. It frees up their branch staff during the summer peak, their busiest time. Instead of wrestling with year-end closing, they can focus purely on customers and sales. That's smart resource allocation.
Makes sense. We also saw them keep up the pace on M&A. 9 deals in fiscal 25. 4 just in Q4.
Yeah, that's their classic tuck-in strategy. Very disciplined. They're targeting specific growth areas, like bolstering HVAC with manufactured duct, expanding in waterworks into specialized stuff like process equipment through deals like Ritchie Environmental.
So not just buying revenue, buying expertise and density.
Exactly. Consolidating fragmented markets where they can add value.
Did management inject any, near-term caution despite the strong outlook overall?
They did, a little bit. While the full year looks solid, they signaled that growth in the second half of the calendar year might be, quote, a touch softer than the roughly 5% seen in the first half.
Was that?
Continued drag from new residential weakness, mainly, and affordability issues. They pointed specifically to HVAC consumers choosing repairs over full system replacements because of cost pressures. That hits volumes.
Okay. So connecting this to the bigger picture.
Yeah.
Why does FRE keep outperforming? What's the sort of core competitive advantage letting them navigate this residential softness so well?
I think it's fundamentally their unique multi-customer group model. They aren't just, a pipe supplier. They handle complex niches, waterworks, commercial mechanical, fire protection, industrial PVF.
Right.
That breadth lets them offer a really compelling package for those huge complex capital projects we talked about.
So for things like data centers, which they called out as accelerating the cost of materials, is small compared to the cost of labor delays, right?
Okay.
FRU sells certainty.
Precisely. These sell supply chain reliability at scale. On a massive data center build, a delay costs fortunes in labor. Fergie ensures the specialized stuff is there. That's huge value for the contractor and the owner, and the market sees that. Look at Fergie stock versus the broader industrials, the XLI. It's outperformed.
And that complexity focus must tie into their push with dual trade contractors, too.
Absolutely central. They're actively trying to convert contractors who do both residential and commercial work. Get them using the full Ferg network.
The counter-conversion strategy.
Yeah, pulling them away from single-line suppliers by showing the breadth and reliability Ferg offers. It's about capturing more share of wallet from existing relationships.
And underpinning all of this strategy.
The balance sheet.
Rock solid. Net debt to EBITDA is down at 1.1 times. That's the low end of their target range.
Which gives them firepower.
Immense firepower and flexibility for more M&A when the right opportunities pop up. A big advantage over competitors who might be more stretched. All right, now for our segment. This is not financial advice. This is where we pitch a potentially interesting, maybe slightly outrageous trade idea based on what we heard.
And the usual disclaimer applies. This isn't a recommendation. Do your own homework.
Okay. So the core idea is this. Fergie is really nailing this strategy of being a consolidator that's upgrading its business mix towards higher margin non-residential work. They've kind of decoupled their profit engine from the worst of the housing slump.
Right.
But the market might still be applying a bit of a discount because of general anxiety about housing, that sort of sector-wide gloom.
People worry about the housing slowdown hitting everyone, even if Fergie has shown resilience.
Exactly. So the trade idea is a pair trade. Go long Fergie,
Okay.
funded by shorting a high-beta, pure-play residential building products supplier, a company whose fate is really tied tightly to new housing starts and maybe consumer RMI spending.
Ah, so you're isolating Fergie's specific execution alpha from the general sector beta.
That's the rationale. The trade works if AirRG keeps executing, keeps controlling margins, keeps benefiting from that non-race strength, effectively defying the broader residential macro story. You're betting on the superior business model and execution against the sector headwinds.
Interesting structure. So wrapping this up, what's the main takeaway for you, for the listener? I think HRG delivered a really clear, high-quality profit beat. It was driven by solid margin control and, crucially, that big success in higher value non-residential markets, especially those data centers and infrastructure projects.
Yeah.
And that performance gives real confidence they can hit that mid-single-digit growth target for the calendar year, even with housing still uncertain. And the shift to calendar year guidance, that just makes things cleaner for everyone watching.
And maybe here's a final thought for you to chew on. They mentioned that counter-conversion strategy, targeting over 650 dual-trade contractors. They're actively taking share right now in these conditions. So if this distribution platform is already capturing volume and share while housing is soft, just imagine how much more explosive volume and share FRG could grab when the residential market eventually does stabilize and maybe even becomes a tailwind again. How much upside is really baked in for that?